Turning now to a bond market moment with PTAM. Joining us for that is Sean DranField, the CEO of PT Asset Management. Good to have you with us. President Trump is chalking up tariffs, which is closely tied to the economy, as consumers, importers, or companies wind up paying more for those goods. How is that playing out in the bond market?
Yeah, so what's happening currently is the bond market is assuming that the impact of tariffs will be bad for the economy in the short term. So these increased costs will either be passed on to consumers, which will drive inflation up, or the increased costs will be somewhat borne by importers, which will erode corporate profits, which may reduce profits, could create job losses on top of the potential job losses of federal workers as well. So currently the bond market is thinking that this may have a downward impact on the economy. And as a result, we now have an inverted yield curve again, which hasn't really happened since last year.
And that means the short-term interest rate, such as a 2 or 3 year bond, is now higher than the rate on a longer-term bond, say a 10-year. That can also signal the possibility of a recession or even a higher probability of rate cuts by the Fed eventually. What does this mean for investors? What would be a suggestion?
Thanks, Angie. So I think we're in a period of a little uncertainty right now. So my advice would be to remain diversified and be open-minded as to what may ultimately play out, because I think, frankly, we really don't know how these tariffs are ultimately going to play out. Are they a negotiating tool, which will mean that tariffs are only implemented on a short-term basis, or will these persist for a prolonged period of time? And at this point, we really don't know.
All good points. We thank you, Sean.
Angie, thanks so much for having me again on your show.